an IRA in general is an investment vehicle. Oftentimes, folks are confused with the fact that they have an IRA and they don't realize that really they have the full spectrum of investing available to them inside that IRA. It's just a vehicle, but once your money's in the IRA, you can invest it in stocks, in bonds, in mutual funds. You can invest in real estate. You can invest in your own business, theoretically. So really the IRA is a vehicle. It's a place where your money is held, but it becomes an investment that you have a variety of options in terms of how you want to invest that money. So a Roth IRA and a traditional IRA have different tax implications. Investing into a Roth IRA does not provide a current tax benefit to the individual investor, whereas investing into a traditional IRA provides an immediate and current tax benefit because you're able to take a deduction for the contribution that you make into a traditional IRA. A Roth IRA, the tax benefit really is associated with the future because the income that you generate and the growth that you realize inside a Roth IRA is never taxable to you. At least under current tax law, when you take distributions from a Roth IRA, you are not paying tax on those distributions. So any of the value that is accumulated inside a Roth IRA, as you distribute that out to yourself, it's tax-free. So you get the tax benefit in a Roth IRA on the back end when you're taking the money out from that investment. Whereas a traditional IRA, as you're contributing money to the traditional IRA, you're taking a deduction on your income tax return and getting the immediate tax benefit of having made that contribution. When you do take a distribution from that traditional IRA in the future, it is now taxable to you. And so you will pay income tax on the distribution. And so depending on the tax circumstance of an individual today versus the future, what their tax needs are now versus what they expect their tax needs to be in the future, a Roth or a traditional can be more or less beneficial. So it's very dependent upon the individual unique needs of the particular investor. Yeah, the good thing about Roth and traditional IRAs is that they're not mutually exclusive, so to speak. You can have both going on simultaneously. There are tax rules about who can contribute to a Roth or a traditional IRA depending upon the level of their income, depending upon whether they're already participating in an employer-sponsored retirement plan, for example. But from a generic perspective, you can have both a Roth and a traditional IRA going on simultaneously, and you could utilize the benefits of both. For example, a lot of 401k plans have now introduced the option to utilize a Roth component to a 401k. So someone at work can contribute to their 401k and they could contribute some of their funds into that 401k into the Roth side of the 401k and some of their funds into the traditional side of the 401k and kind of get the benefit of both ends of those spectrums, get a current tax benefit today, but also from the Roth perspective, you're kind of setting yourself up for a benefit in the future when you end up taking those distributions. One of the services that we present to clients when we're looking at their overall financial plan is to focus on their retirement planning needs and their objectives related to those retirement planning requirements. And a Roth IRA or a traditional IRA will oftentimes be one of the most important solutions to those long-term retirement goals. And we would help establish the IRA for the client and help make the investment allocation choices associated with those IRAs. Certainly, there are so many options for individuals to open up or establish IRAs. They can do it online, they can do it at banks, they can do it with financial planners and investment advisors. But not unlike the overall financial planning process, it's critical to be sure that you're constructing a Roth IRA or a traditional IRA, just like all of the other elements of planning, in a manner that addresses your specific personal objectives and is consistent with the long-term goals that you're establishing. Oftentimes, with the full investment perspective, individual clients don't necessarily consider all of their investment accounts when they're trying to assess risk or the types of investment diversification that they should have. And so it's important that any Roth IRAs or traditional IRAs are considered in conjunction with other 401k plans or other general investment accounts that someone has, so that the full picture is being addressed and considered when they're really looking at their true diversification or true levels of risk that are associated with all of their investments. In terms of retirement accounts, setting up an IRA, whether it's a traditional IRA or a Roth IRA, is really appropriate or applicable at pretty much any stage of an individual's overall lifetime. Really from the early phase of work life, late teens, early 20s, an IRA is a great vehicle to establish, to begin the retirement savings process. It creates a tax benefit, it creates growth that will not be subject to tax, at least now and potentially never in the case of the Roth. So there's so many great advantages from a time frame to start as early as possible to establish an IRA, whether it's a Roth or a traditional. Oftentimes, once you kind of enter the workforce and you may have a 401k available to you from an employer, it's important to assess the benefits of that 401k in conjunction with whether you should establish a traditional or Roth IRA, or whether you should do both. But oftentimes a 401k incorporates an employer matching your contribution into the 401k. So it's beneficial oftentimes to assure that you're at least getting the benefit of that employer's matching contribution and contributing to a 401k enough to optimize that benefit before you would begin to invest into your own personal traditional or Roth IRA. So again, like all of the planning process, you're trying to consider several different elements of your overall planning situation simultaneously to assess what the optimal decision is amongst each of those decision-making processes. But a Roth and a traditional IRA are very important components to an overall plan from the early stages.